Well, hello, my name is Mark Rizik. I am the head of the tax department at Miller Johnson. I'm here with my colleagues, Raj Malviya, Neil Williams, and Hunter Reams. We want to welcome you to this morning's webinar being put on by Miller Johnson's COVID-19 response team. The webinar will focus on tax provisions of the various relief and stimulus statutes and administrative actions that have been enacted or issued in response to the COVID-19 pandemic. Now, as the webinar goes along, you may have questions that you would like answered. Because we have a large amount of material that we have to cover today, we likely won't have time to deal with your questions during the webinar, but please feel free to follow up with us after the webinar to get your questions answered. And so that you can follow up with us, at the end of the slide presentation, you'll find our names and contact information. Now, the substantive presentation starts at slide 3, and you'll notice that the title to this is the CARES Act Key Tax Provisions. But there's more today in today's presentation than just the CARES Act. Some of what we'll discuss came down to us by administrative action. A little of what we'll discuss relates to another statute, the Families First Coronavirus Response Act. And some came down to us through state executive orders. But all of what we are going to talk about was designed as relief or stimulus for individuals or businesses or other taxpayers that have been hurt or will be hurt by the COVID-19 pandemic. Now, first, I want to talk a little background. I've been a tax lawyer for a long time. I started with the IRS and Chief Counsel's Office in 1982. I also worked in the Department of Justice. I've seen a few recessions and near recessions, and I've seen many stimulus and tax acts, but I've never seen anything like this. Of course, the sheer size of this program and the dollars involved are greater than any of us has ever seen. But the class of intended beneficiaries is a broader class than I've seen. There's something in these statutes and actions for everyone: individuals, businesses, trusts, estates, governmental entities, even tax-exempt organizations. So I encourage every organization and individual to take a serious look at these relief and stimulus provisions to see whether they will benefit you. And now can we go to slide 4 and 5? On slides 4 and 5, we have a list of the topics we'll discuss. I'll give you a second just to glance through that. I'm not going to go repeat that entire list right now. Just want you to have an idea of where we're going with this webinar. Now I'd like to jump to slide 6 and get right into the meat of our discussion. I'll start with the Employee Retention Tax Credit. It's one of the provisions that has garnered great interest, and this credit is designed to help employers who keep employees on the payroll when COVID-19 forces the employer to suspend or close operations, or when COVID-19 significantly reduces their revenue. As slide 6 indicates, employers can receive a payroll tax credit for paying their employees. The credit is equal to 50% of up to $10,000 in wages per employee. Therefore, the credit is capped at $5,000 per employee. The credit is a credit against not all payroll taxes, but just the employer's 6.2% share of what we call Social Security taxes. That means it does not offset the employer's share of Medicare taxes. It does not offset the employee's share of Social Security or Medicare taxes. It does not offset federal income taxes withheld from employees. and it does not offset unemployment taxes. Lastly, it does not offset any state or local payroll taxes, but it does, as I said, act as a credit against the employer's 6.2% share of Social Security taxes. And if the credit exceeds an employer's Social Security tax, the excess is supposed to be refundable, or although I haven't seen exactly how the refund procedure will be. Slide 7. Now, not all employers are eligible for the credit. The statute starts out by saying that the employer must operate a trade or business, which is a common concept in the tax world. Some examples of people who don't operate trades or businesses are people hiring domestic help, family offices, and generally tax-exempt organizations. However, in language that is not all that clear, the statute seems to indicate that the trade or business requirement will be dropped for organizations that are exempt under Section 501C of the Internal Revenue Code. And that is how most commentators are interpreting that language. That is, that 501C organizations are eligible if they meet other requirements. So some of the other requirements that an employer must meet are that their operations, they must have had operations that are fully or partially suspended due to a COVID-19 shutdown order, or they must have experienced a 50% reduction in quarterly receipts compared to the same quarter last year. Now, the size of the employer determines the scenario under which the employer can qualify. The cutoff point is 100 employees. When an employer has more than 100 employees, the credit is going to be based only on qualified wages paid to employees when another employee is not providing services because of a suspension. When an employer has 100 employees or less, the credit can be based on wages, not only when there is a shutdown, but also when the business has experienced a sharp decline in gross receipts. I suspect that after the shutdown, when businesses get fully back to work, this credit will be one of the most often used, when businesses get partially back to work, this credit will be one of the most often used relief provisions from the CARES Act. But note this, as is the case with several of the tax provisions in the CARES Act, an employer cannot receive both this credit and a CARES Act loan. Now, at this point, I'm going to turn to my colleague, Neil Williams, who will talk to you about the changes in net operating loss utilization and other income tax deduction and credit expansions. Neil?
Thanks, Mark. On this slide discusses the changes the CARES Act made to corporate net operating loss carryback rules. Like the tax credits Mark just discussed, this is a change in the rules that's focused or intended to try to generate some additional short-term liquidity for taxpayers that can take advantage of these rules. So on this slide, we're discussing the rules. On the next, or the changes to the rules. On the next slide, we'll get into a short discussion on some of the practical implications of what can be done with these rules to get some short-term liquidity. So teeing up this rule change, prior to CARES, net operating losses could only be carried forward. They could not be carried back. And that was a relatively recent rule that it could not be carried back. It was something that went into place in connection with tax reform in 2017. Also prior to CARES, net operating loss carry forwards could only offset 80% of taxable income in a given year. And as an example of what those rules meant, say you had $1,000 in net operating losses in 2016 and $1,000 of taxable income in 2017, First of all, if you had taxable income in years prior to 2016, you couldn't take that 1,000 of net operating loss in 2016 and carry it back to, say, 2015 or 2014. Also, when you took that $1,000 of 2016 net operating loss and carried it forward to offset your $1,000 of 2017 taxable income, you couldn't offset your full $1,000 of taxable income in 2017, even though you have $1,000 net operating loss. You could only offset 80% of that 2017 taxable income, so $800. You would pay tax on your remaining $200 of taxable income, and you would carry forward the remaining $200 of 2016 net operating loss that you hadn't used to future years. Under CARES, net operating losses arising in taxable years beginning after December 31st, 2017, and before January 1st, 2021 can now be carried back for 5 years. And so if you're a calendar year taxpayer, what those dates essentially mean is that you could look at net operating losses generated in 2018, 2019, or 2020, and now you have the opportunity to carry those back 5 years if you have taxable income that you paid tax on in prior years, in those 5 prior years specifically. Additionally, under CARES, net operating loss carrybacks and carry forwards can be used to offset 100% of taxable income in a given year. So in the above example where we had $1,000 in net operating losses in 2016 and $1,000 of taxable income in 2017, you would now be able to offset the full amount of your taxable income in 2017, the full $1,000 with your $1,000 in net operating losses from 2016. And the last bullet on this slide is just a reminder that although we have changes to the net operating loss carried back rules under CARES, there's no changes to the net operating loss carried forward rules. Those can still be carried forward indefinitely. Jeff, next slide, please. Okay, so this is the slide I mentioned where we're going to go through some of the practical implications of what these changes to the net operating loss rules mean. If you're able to take advantage of these, and how, if you're in that situation, it can get you some additional short-term liquidity. Corporations with 2018 or 2019 net operating losses that they were carrying forward can file amended returns seeking refunds immediately. So if you've already filed the 2018 or 2019 tax return with a net operating loss, you can now file an amended return carrying back that loss to, for example, 2016 or 2017 if you had taxable income in those years. One point to take note of when you're trying to, if you're in this situation where you have net operating losses from 2018, 2019 that you carry back, is that carrying back net operating losses to the 2017 tax year or earlier will maximize the refund that you can claim by offsetting tax at the pre-reform 35% corporate income tax rate, as opposed to offsetting tax in 2018 or 2019 against the post-reform 21% corporate rate. So what that means is that if you had $1,000 of net operating loss for 2020 and you had $1,000 of taxable income in both 2017 and 2018, and you needed to choose which year to carry back your 2020 net operating loss to offset, carrying back to 2018, which is post-tax reform, in a year in which corporate tax rates are 21%, in that case, your $1,000 of NOL effectively gets you $210 of cash tax when you carry back your $1,000 NOL. Instead, if you had carried that NOL back to 2017, when 35% corporate income tax rates are in effect, in that case, if you can utilize the full $1,000 of net operating loss in 2017, that gets you a cash tax refund of $350 rather than the $210 if we had carried back to 2018. Another practical implication for people to start thinking through is, even if you don't have net operating losses in prior years that you can think about carrying back, if you're anticipating a net operating loss in 2020, you'll be able to carry that loss back, but you should probably also review the year-to-date estimated tax payments that you've made to try to get a sense of whether, based on the rapid downturn in business that a lot of businesses experienced just in the last month, if you're like everyone else and you really didn't have a chance to foresee that coming, you might be overpaid on your estimated tax payments year to date. You'll have a refund coming due in 2021. And if that's the case, discuss with your tax provider the option to apply for a quickie refund. You do that by submitting Form 1139 with the IRS. And essentially what it is a way to estimate the amount of tax that you think you overpaid immediately or very quickly in January. File a short form to notify the IRS of that overpayment and request your refund based on your estimate. And then following up on that in typical tax season, you can true up that estimate to the true amount, but it would still give you the opportunity to get a significant portion of your cash on that refund earlier in the year by using the quickie refund procedure. And one point to be aware of, just when anyone's trying to analyze how the rules will apply to their situation and project the benefit of carrybacks, when you carry back a net operating loss, that can affect the calculation of tax credits and deductions in the prior years that you carry back to. So just something to keep in mind that there's a little bit more calculus here than simply looking at a net operating loss that you're carrying forward and applying that to taxable income that you paid in prior years. Next slide, please, Jeff. This slide discusses changes the CARES Act made to loss limitations on non-corporate taxpayers. The idea here being similar to what was done for corporations, in that the service is trying to look at losses that were limited in the opportunities they had to offset taxable income in prior years and open up those losses so that amended returns can be filed. To tee up this specific change, prior to CARES, the amount of business losses from a flow-through entity that an individual could use to offset non-business income was limited to $250,000 for a single filer, $500,000 for joint filers, and excess losses were carried forward as an NOL. So what that meant is that if you were a taxpayer and you were the owner of any mix of a sole proprietorship, partnerships, or S corporations, and you had generated, or those businesses generated, say, $1 million of loss for you in a given year, and you also had $1 million of wages from, say, ordinary income from a W-2 job or investment income, even though you had $1 million of loss and $1 million of other income, you could only use $250,000 of that loss if you're a single filer, $500,000 if you're a joint filer, of your flow-through loss to offset your other income. What CARES did is it eliminates that $250,000, $500,000 limitation for tax years beginning in 2018, 2019, and 2020. And the practical implication of this is similar to what we discussed in the net operating losses, the carryback ability for corporations, in that this change allows taxpayers who fall within these fact patterns to file amended returns for 2018 or 2019 if you've already filed, and then also to factor these into your filings that you might still be planning to make for 2019 or 2020. And if you're carrying back, if you're amending a prior year like 2018, you can use that amended return to claim an immediate refund and get cash in the relatively short term. Next slide, please, Jeff. Okay, this slide discusses the changes the CARES Act made to AMT credit carry forwards. And to tee this change up, prior to 2017 tax reform, corporations were subject to a corporate alternative minimum tax, or what was commonly known as the AMT. 2000 tax reform eliminated the AMT, and corporations with remaining AMT credit carry forwards were generally required to spread those carry forwards over a 4-year period that would end in as late as 2021, but the soonest 2020. Under CARES, a corporation with remaining AMT credit carry forwards that it was expecting to utilize in 2020 or 2021 can now be used to claim a refund for any remaining AMT credit carry forwards on that corporation's 2018 or 2019 tax return. So I think for this rule, we're starting to get into a little bit more specific situations. This isn't going to apply to all taxpayers, but if you were subject to AMT prior to tax reform and you had any credit carry forwards, then this would be another tool within the tax code for you to use to potentially free up some short-term liquidity by filing an amended return carrying back your AMT credits in 2018, file an amended return for 2019 if you've already filed, or if you haven't filed 2019 yet, then you could build this into your 2019 return. Next slide, please. Okay, this slide discusses changes the CARES Act made to interest expense limitations. And first, specifically in this slide, we're going to talk about changes, the way they impact corporations. And then in the next slide, we'll talk about partnerships, because there's a little bit of a twist in the way that these changes apply to partnerships. Again, teeing this change up, generally, interest expense deductions for a taxable year cannot exceed the sum of a taxpayer's business interest income for the year plus the taxpayer's floor plan financing interest expense for the year plus 30% of the taxpayer's adjusted taxable income for the year. CARES increases that adjusted taxable income limitation from 30% of adjusted taxable income to 50% of adjusted taxable income for 2019 and 2020. CARES also allows taxpayers to elect to use their 2019 adjusted taxable income to compute 2020 adjusted taxable income limitations. And if you think about what that means from a practical perspective, the drafters contemplated that, a lot of businesses probably are going to have had a lot better year in 2019 than they're going to have in 2020. So what that point does when they say that you can elect to use your 2019 adjusted taxable income, they're saying go ahead and use what we're presuming, or you have the option to use what we presume would be a lot higher adjusted taxable income number from 2019 when you're computing the amount of your 2020 interest expense that would be limited by the 50% adjusted taxable income limitation. And the last bullet on the slide, this is one more area where a taxpayer, looking through these rule changes and trying to see if they can get any short-term liquidity, they could file returns seeking refunds for 2019 now in order to get cash in the short term. Next slide, please. Oh, we're already there. Okay, this slide is just discussing how the interest expense limitations we discussed on the last slide apply a little bit differently for partnerships. The big change is that for partnerships, the increase in the adjusted taxable income limitation from 30% to 50% only applies for the 2019 tax year. For corporations, you had the ability to use, or you will have the ability to use the 50% limitation in both 2019 and 2020. For partnerships, you can only use that limitation, that expanded limitation for 2019. And the final note on this slide, there are other special partnership rules or special impact. There are changes on the way this rule applies to a partnership. They're beyond the level of tax technical discussion that we wanted to get into on this presentation, but I think suffice to say, if you're a partnership and you've been subject to the adjusted taxable income limitation in prior years and you're thinking that you might be able to utilize the 50% limitation for 2019, we would recommend that you follow up with us or consult your tax advisor. But before you start to really make projections based on that number, make sure you understand how the rules will apply to your partnership. Okay, and with that, Jeff, next slide, please. And I'm going to turn it over to Hunter. Hunter, go ahead.
All right, thanks, Neil. Good morning, everyone. My name is Hunter Reams. I'm an associate in the business section, focusing on tax and M&A. So now we're going to move to bonus depreciation for qualified improvement property. So this has been a bit of a lower profile but key provision of the CARES Act that can accelerate current cash flow benefits and relief to taxpayers, especially those in retail, restaurant, or hospitality industries, or really in any industry that is often opening or renovating locations. So qualified improvement property refers to any improvement made by a taxpayer to an interior portion of an existing building that is non-residential real property. So residential rental property is excluded from this. Examples of such improvements would include installation or replacement of drywall, ceilings, fire protection, electrical and plumbing, etc. Then things that would be excluded from this definition are improvements attributable to internal structural framework of buildings, enlargement to buildings, elevators, escalators, things of that nature. Next slide, please. So this provision gives qualified improvement property a 15-year depreciable tax life, reducing it from 39-year depreciable tax life as it was before. What this means is it allows for larger depreciation deductions and allows qualified improvement property to qualify for bonus depreciation. And this is important because it allows a larger offset of taxable income. Additionally, this provision is retroactive, so you may amend your 2018 federal income tax returns to take advantage of this provision as well. And this can provide for some great planning opportunities. For C corporations in particular, claiming bonus depreciation on an amended return can potentially generate new net operating losses that could even be carried back up to 5 years in tandem with these new other CARES Act provisions that Neil just discussed. So there's definitely a lot of creative tax planning opportunities with qualified improvement property in tandem with other CARES Act provisions. Next slide, and I'll now switch it over to Raj Malviya.
Thanks, Hunter. Good morning, everyone. Hopefully you're on your second or third cup of coffee right now. Thanks for staying with us. Again, my name is Raj Malviya. I'm a partner in the private client group at Miller Johnson. So while my colleagues here on the call deal mostly with the business, employer, and procedural aspects of tax, I deal primarily with the individual side, transfer taxes and fiduciary income tax, and charitable organizations. And this is a $2 trillion stimulus bill, and a lot of it covers corporations, small businesses, state and local governments, public services, but 30% of it is really geared towards individuals. And of that 30%, there are some provisions in the CARES Act that deals specifically with retirement plan accounts, some educational type provisions that benefit individuals, and some charitable contribution types of provisions. So I'm going to be covering those. And we're starting on slide 16 here. So just a little background to try and get into the substance here. You know, before CARES Act came out, which is the focus, for the first part of the year, January and February, the big focus in the retirement planning community was the SECURE Act. That's the Setting Every Community Up for Retirement Enhancement Act. And what SECURE Act did was dramatically change the way retirement plan accounts, so think qualified accounts, 401ks, think 403bs, IRAs, how they were administered when paid out to a beneficiary. And we're not going to get into those rules, but one of the things that the SECURE Act did was when you have retirement plan accounts, these are pre-tax dollars funding an account, growing, and at some point in time, the participant or the owner of the account has to start draining the account and paying the income tax. And so we have rules under the tax laws that say that once a participant or owner reaches age 70 and a half, that's when the account starts to flush out and income tax is paid on those distributions. Those are called required minimum distributions. RMDs is the acronym. And what SECURE Act did was it upped that age a bit, and it took it to age 72. So part of that was probably because people are working longer, they're living longer, they're earning income longer. So in any event, the general rule here, as we see on this slide, is that retirement account participants and IRA owners have to start taking those RMDs, draining that retirement plan account, and paying income tax on the distributions at age 72. So what the CARES Act does is it provides some relief to that in the sense that for 2020, the 2020 calendar year, as individuals are calendar year taxpayers, there's an RMD waiver. So instead of forcing a participant or an IRA owner to start draining that RMD for 2020 and paying income tax on that, there's a waiver specifically for this year, and it's this year only. At least that's how the legislation is drafted. And so, you know, part of the idea here is that for those individuals who don't need RMDs or for whatever reason don't want to take RMDs this year, there's also an economic impact that we're seeing with the market, obviously. And so if the goal is to let that money ride, leave it in the market, hopefully allowing for it to, perform better once the economy returns, then this year the owner or the participant is not going to have to pay income tax and drain that RMD for this year. Now, the flip side of this is for those who are charitably inclined, those who make contributions to charity, one of the rules that we've had for a long time is called the Qualified Charitable Distribution, the QCD. And what you might see is that every year an individual, a plan participant, or an owner has the ability to take up to $100,000 if they've reached a certain age and contribute that directly to a charity. So instead of paying the tax on that RMD, they will have the custodian of the retirement plan account send that money directly to a public charity, and that's up to $100,000. So as you can see, this RMD waiver this year may impact, unfortunately, detrimentally, the QCD contributions, because there are taxpayers who make those QCD contributions not only because they're charitably inclined and they want to do good, but also because it avoids paying income tax on that RMD. Let's go to the next slide, please. Another rule that we can extract from the CARES Act is some penalty relief on early withdrawals. So when the pandemic was announced, and taxpayers were beginning to think about all of the different aspects of their financial world and what could be done to not only raise cash but what resources were available, it's undoubtable that there are going to be some reviews of retirement plan accounts as a resource to help get through the economic downturn. And we know the general rule that retirement plan accounts are meant to be there until a taxpayer reaches a certain age. So if these pre-tax dollars are withdrawn before reaching a certain age, that age is age 59 and a half, there's a penalty, and it's a 10% penalty, and there's a laundry list of exceptions to that. So some of the exceptions might be education or hardship or buying a home for the first time, medical expenses in some cases, court orders dealing with family law or domestic related issues. But if a taxpayer doesn't fit in one of those exceptions, then there's a 10% penalty for withdrawing from a retirement plan account early being, again, before age 59 and a half. And so in light of the COVID pandemic, what the government has done, what legislation has done in the CARES Act is waive that penalty. And it's a temporary waiver. It's only for 2020. But the specific new rule basically allows a withdrawal, an early withdrawal before age 59 and a half, up to $100,000, if it's made related to the COVID pandemic, and how the rule is defined as it has to be made by a qualified individual. So if we flip to the next slide, we know from the legislation that a qualified individual is someone who needs the early withdrawal due to the COVID pandemic, and the definition is fairly broad. It's not only because of a diagnosis of the virus, but family members in the household, financial issues related to the pandemic, hardship, and other related factors. So if we flip to the next slide, this is like many other rules under CARES, this is definitely going to be I think, in my view, a utilized provision, but also one where we're going to need some more guidance. How I think of it too, not only working on the private client side, but working with the plan administrators of these accounts, is that, how are we going to perfect, the reason for the withdrawal? Is it going to be, a medical opinion, a doctor's note? Is it going to be the honor system? The participant or the owner will have to self-certify in cases. And so I think it could be difficult for plan administrators to, efficiently carry this out. And so we'll hear more from our employee benefits team on issues like this. And then in addition to an early withdrawal without penalty for 2020, there is the option, as many of us know, to borrow against our retirement plan account. And, some of us have done that for various reasons. If you speak with a financial advisor or a wealth planning expert, I think the school of thought in that camp is advising against that because it eliminates the ability to, invest pre-tax dollars in good markets. But, the bottom line is we're in a pandemic, as Mark mentioned earlier, that, many of us have not experienced before. And I think using retirement plan accounts as a resource of funds in times of need is going to be, a viable option. And so loans are still available, and what the CARES Act did was it essentially increased the borrowing ceiling. I think currently it was $50,000 was the limit for various reasons, and now that ceiling is up to $100,000 under the CARES Act for 2020. Let's go to the next slide to keep this presentation moving. We want to save time for some of the follow-up slides that Mark has yet. So this is another I would put this in the other category. It kind of fits in the individual tax, but it also relates to employers as well. And many of us don't know about this rule, but it's been out there for quite some time, and this is really, I believe it's Section 127 of the Internal Revenue Code, but it's a provision that essentially allows employees who are part of a educational assistance program with their employer. Educational assistance being, tuition, books, supplies, fees for an educational program. It doesn't have to be a degree program, to essentially have their employer cover up to a certain amount of those types of education assistance program costs. And it's generally a deduction for the employer, tax deduction, but the benefit to the employee on the individual side is being able to exclude up to $5,250 per year for these payments. It's not treated as taxable income to the employee, and it's only for the employee directly, not for spouses or dependents. So if we go to the next slide, what we see here is part of the CARES Act is trying to expand on that educational assistance, where now we have employers that can help employees repay student loan obligations. And this is a temporary provision that's only through 2020, so there is a time deadline for this type of relief. And again, this is another provision that is going to require some more guidance, because it kind of crosses over on what will be required on the employer side. How do we certify that these are eligible student loan repayments? And so we'll be looking for more guidance on this particular rule. If we can go to the next slide, please. So we talked earlier about the RMD waivers for 2020 and the potential impact that may have on charitable contributions, specifically that ability to, essentially make a contribution directly from the retirement plan account to charities and exclude that income up to $100,000 if you've met certain requirements. Now, to kind of offset that potential impact, at least this is how I want to think the legislators thought through this, is we now have incentivized some additional charitable contributions. And the reality is, charities need help, public charities. Think of all the charitable organizations that are involved right now trying to deal with the pandemic and help. They need funding. And so what we have here is a provision in CARES that does a few things. This slide, 22, talks about essentially a new charitable contribution deduction. And generally, charitable contributions by individuals are known as itemized deductions. So those are below the line, meaning that we first calculate adjusted gross income before we then start taking out additional deductions that are still available. Above the line deductions they function a little bit differently. They come off the top before we reach our adjusted gross income. And so some of the common above the line deductions we know about, health insurance premiums, qualified plan contributions, SECA tax, educational type expenses, student loan interest. Those are just some examples. And so now we have a new above the line deduction. And this is going to be contributions to public charities. And there is a threshold on that. If we can flip to the next slide, it's a $300 contribution. So, it's a nominal amount, but it's still meaningful. And you have to think about it where it will benefit charities that really require, modest gifts, but from a large number of donors to survive and thrive. And what this also does is, if you think about the Tax Cuts and Jobs Act, which we saw come into play when, the Trump administration took office a few years ago, this I think helped taxpayers in many regards, but it also had, to help fund the Tax Cuts and Jobs Act, it had to, get rid of some of our tried and true, beloved itemized deductions, like state and local state tax and property tax and local tax deductions. Those were capped at $10 million under the Tax Cuts and Jobs Act. Home equity, interest. I mean, there's a laundry list of itemized deductions that were cut. Some were maintained, like grandfathered mortgage interest, and charitable contributions were maintained. But we also learned from the Tax Cuts and Jobs Act that the standard deduction was doubled. So what we saw as a result of the Tax Cuts and Jobs Act was kind of a flip where many taxpayers with itemized deductions, that really cut out the number of taxpayers doing that and flipping to just taking the standard deduction. And so what this charitable contribution, this new above-the-line deduction does is it still allows for a charitable deduction even for those who don't itemize, aka those who still, those who file their taxes on a postcard is what we like to think of, what Tax Cuts and Jobs Act supposedly tried to do. We can go to the next slide, please. Slide 24. Just want to get through the next few slides here in the next few minutes. So on slide 24, another rule that came from the CARES Act is an increased ceiling threshold on charitable contributions. So we talked about this new above-the-line deduction. So now we're focused on below-the-line deductions, which are also known as itemized deductions. And what the Tax Cuts and Jobs Act did was it allowed taxpayers to contribute cash to charitable organizations, qualified charitable organizations. Pre-Tax Cuts and Jobs Act, it was a limitation. The ceiling on that was up to 50% of your adjusted gross income. What Tax Cuts and Jobs Act did was it increased it to 60%. So it increased the threshold, which allowed for a higher charitable contribution deduction if you were so inclined to be that generous. And any excess over that would be carried over for 5 years. So, I just did a quick example. If your adjusted gross income is $100,000, 60% of that is $60,000. So in a calendar year, if you contribute $60,000 to a qualified charitable organization, then you can deduct that entire amount. If you contribute $70,000, then your threshold is limited to $60,000, so that $10,000 would then carry forward for 5 years. And so if you go to the next slide, I think this is kind of the key takeaway here is for 2020 only, for this year only, that 60,000 AGI limitation is gone. The ceiling is waived, and there are some limitations on this. It's going to be to public charities, qualified charities. It can't be to donor advised funds, which is what you see a lot of in my practice with families who will set up donor advised funds to organize their charitable contributions. Supporting organizations, there's various types of supporting organizations. Those are apparently not included as we interpret the new legislation. So it is, I think, helpful to public charities. It will allow those who can give and afford to give to maximize those distributions, those contributions. But in any event, that's what it does. So if we go to the next slide, just finishing up, I think this is kind of a good segue to Mark, and what we've seen over the past week are, a slew of notices from the service on filing return deadlines, filing extensions, and tax payment deadlines for various different types of returns and types of tax. And so, Mark, I don't want to steal your thunder. If you're with us, I'd like you to take over here on slide 26.
Hey, thanks, Raj. And anytime you want to jump in on this, feel free. But one of the first relief actions to garner a lot of attention and feedback was the extension of the April 15th filing date for income tax returns. At first, as probably most of you know, the IRS extended just the filing date to July 15th. In other words, taxpayers still had to be fully paid by April 15th. And they received a lot of comments from tax practitioners and taxpayers about this. In fact, I was called the night before a group was supposed to talk with Treasury and some representatives from the Senate. They asked me to edit their comments. And the big concerns, were, one, they were forcing people to meet, which is contrary to what the guidelines say regarding our response to COVID-19. And secondly, they were going to create a payment deficiency mountain that they might not be able to crawl out from under because of the fact that people just, they suspected that the initial action would result in a lot of payment deficiencies and penalties and interest. So anyway, IRS got it correct eventually. Where it stands now is that the April 15th tax filing and tax payment dates have been extended. Let's look at the specifics on that. The April 15th income tax filing deadline for 2019 income tax returns is extended to July 15th. This applies to individuals, corporations, trusts, and the states. There's no need to file an extension form to take advantage of the July 15th extended due date. It's extended without any action on your part. If you find that you cannot file by July 15th, file your standard extension forms. But note this: one, payments are still due by July 15th. And two, a filed extension form will only give you a 3-month filing extension beyond July 15th, not the normal 6 months. The last time I checked, not quite all the states had extended their deadlines. So for you multi-state taxpayers, check on all the states in which you have filing obligations to see whether they have extended. Michigan has extended the Michigan and Michigan City income tax filing dates by 3 months. That was announced in Executive Order 2020-26. Slide 27, please. As I stated earlier, the U.S. Treasury ultimately got it right and extended the income tax payment dates. The April 15th tax payment deadline for 2019 returns has been extended to July 15th. Again, this applies to individuals, trusts, estates, and corporations. The April 15th estimated tax payment deadline for the 2020 taxable year has also been extended to July 15th. However, the June 15th estimated tax payment deadline has not been extended, so those estimated tax payments are still due on June 15th. Note that delaying your payment to July 15th for the extended payment deadlines will not result in any penalties or interest. And also note that in Executive Order 2026, the governor of Michigan extended the state and city tax payment dates to correspond with the new tax filing dates. And lastly, for those of you dealing with collection issues with the IRS for delinquencies or past obligations, the IRS is relaxing some of its payment requirements for installment agreements, offers in compromise, and other tax collection situations. Slide 28, please. Another one of the extensions deals with the extension of certain payroll tax payment deadlines. Employers can now delay the payment of the employer's 6.2% share of 2020 Social Security taxes on employees' wages. This delay provision only applies to the employer's 6.2% share of Social Security taxes. So similar to the provision we talked about earlier, it doesn't apply to the employer's share or the employee's share of Medicare taxes. It does not apply to withheld federal income taxes. It does not apply to unemployment taxes, and it does not apply to state or local taxes. Next slide. This is how the payment delay provision works. The payment of 50% of the 2020 taxes can be delayed until 12/31/2021. And the other 50% is due by 12/31/2022. A couple of potential traps. Employees using payroll agents or professional employer organizations are still going to be ultimately liable for any deferred tax. So the liability will not be shifted to the agent or the PEO, even if the employer provides them with some of the funds. This is nothing new. This is the way the law always has been. Payroll agents and PEOs, if they fail you, you still owe the tax. Next, this is another one of those tax provisions that's affected by CARES Act loan provisions. Employers whose loans are forgiven under the CARES Act cannot take advantage of this payment delay provision. Next slide, please. So now I'd like to talk about the expanded unemployment benefits under the Act. These really are remarkable. The Act expanded benefits in the following ways. It extends the duration of the benefits. It increases the amount of the benefits. It makes more people eligible for benefits. For example, benefits are extended to self-employed, independent contractors, so-called gig economy workers, and low-wage earners who otherwise didn't qualify. And the Act is retroactive to January 27, 2020 and continues through the December 31, 2020. Next slide. Now, prior to the CARES Act, most states offered benefits for up to 26 weeks, and they required a 1-week waiting period, and they had benefit caps. Michigan's is $362 per week. Next slide. The CARES Act expanded the benefit in multiple ways. First, It extends state benefits by 13 weeks up to 39 weeks. And it will result, once a state signs an agreement with the federal government regarding, they sign on to these expanded benefits, it results in a waiver of the state's normal 1 week waiting period. And it will result in an additional $600 benefit on top of the state benefit for up to 4 months. This last item caused some consternation in the Senate. A number of senators threatened to vote against the bill because the increased benefits could theoretically result in benefits greater than the wages the employees would have earned otherwise if they were employed. They felt that this would encourage employees not to work or encourage their employers to play games. In the end, however, this provision was not dropped. Slide 33, please. So slides 33 and 34 list the reasons for unemployment that make an employee eligible for the expanded unemployment benefits. Rather than go through every one on the list, as you can see from the list, the reasons all relate to unemployment essentially caused by COVID-19. And they include some acknowledgement of how COVID-19 can affect our lives, such as the need to be quarantined or the need to stay home to care for someone else. Some additional qualifications are, slide 35, please. Next slide. Yep, thank you. Some additional qualifications are that employees do not qualify if they can telework with pay. And then next, employees do not qualify if they are receiving sick pay or certain other benefits. The last note on slide 35 about the timing issue. So there's a balance to be struck between unemployment benefits and the Paycheck Protection Program. In short, it's tempting and maybe beneficial to employees to have lower paid employees on unemployment for the full 4 months of the increased benefit. However, if you intend to try to apply for a Paycheck Protection Program, there might be a timing issue. The Paycheck Program is a $349 billion loan facility in essence. Early indications are that many small businesses will try to secure a Paycheck Protection Program loan. The program funds will, I believe, run out fairly quickly. So there is a chance that small employers will have to choose between leaving their employees on unemployment or taking advantage of the Payment Protection Program loan program. And now I'd like to turn over the lines. Hunter, I believe you're next, aren't you?
Yes, I am. Thank you, Mark. So the last topic we'll cover today is the individual recovery rebate credit. So this is one provision of the CARES Act that has gotten significant attention because it's a direct payment program to individuals. So through this new provision, individual single filing taxpayers are allowed to receive up to $1,200, and married couples who file jointly are allowed to receive up to $2,400. In addition, parents are allowed to receive an additional $500 for each of their children. And these credits, similar to the child tax credit or earned income tax credit, will not be considered income. So individuals who qualify for this generally include any individual who has a Social Security number and is not a dependent. So those who would not qualify include non-resident alien individuals, individuals who could be considered a dependent of another individual, or an estate or a trust. And then qualifying children are generally dependent children who are 17 or younger. Next slide, please. And so it is not required that you've filed a tax return in recent years or even have had any income to receive this credit. If you don't file taxes, the IRS can use your Social Security benefit statement or your Social Security equivalent benefit statement to determine the amount of your stimulus check. And then the amount of the recovery rebate credit begins to phase out at $75,000 for single individuals and $150,000 for joint filers. It is eventually fully phased out at $99,000 for single filers and $198,000 for joint filers. And then the phase-out limits are increased by $10,000 for each qualifying child. So the maximum phased-out amount for the adjusted gross income is $218,000 for those qualifying families. It should also be noted that this income limit amount is not gross income, but adjusted gross income. So this includes above-the-line deductions such as retirement, health insurance premiums, student loan interest payments, etc., and will be a lower amount than your overall gross pay. And then the IRS will determine the payments based on the taxpayer's most recently filed federal income tax return. So if a 2019 federal income tax return has not yet been filed, they will use the 2018 adjusted gross income number. As far as timing for receipt of these payments, the Treasury Department is instructed to distribute them as rapidly as possible. And they may certify and disperse the payments through any direct deposit on file, which is generally expected to be received in a few weeks. If there is not a direct deposit on file that's available, the IRS will mail a check to any address on record, and this can take up to a couple of months at most. So there's definitely a timing difference there. And with that, Mark, I'll pass it back to you to say some closing statements.
Thanks, everyone, for joining us. Again, if you have questions, please feel free to contact us. Our contact information is at the end of the presentation. And secondly, we're going to take a look at the questions that you have submitted, and some of us are going to try to get back to you regarding the questions that relate to the areas that we presented on. So thanks very much, everyone, and stay safe.
Thanks, everyone.
Thank you.
Thank you.